Good afternoon. This is Chris Robinson Ag Marketing, with the Sunday night um, podcast. My first time I've done it on a Sunday night. Thanks for tuning in. I'm going to get right to it. We're going to cover what happened last week, maybe look at what we're looking at here as we head into the Sunday night trade and Monday trade. In the letter today, I always try and lead off with explanation of basic hedging. I'm not going to get into that; it's a little bit boring. But if you're looking for that type of information, um, take a look at it, especially if you're new to hedging, if you've never worked with a broker before, if you don't understand how hedges work, options work. That is why I am here to help you with stuff you don't understand, help de-stress your marketing. We're going to go real quick with the money flow. Got to get to that right now. What's going on with managed funds? Um, they're only short 177,000 contracts. They sold only 3,000 um, new contracts last week, and that sounds like a lot, 177,000. But if they really put a big position on it, they can get north of 300 or 400 if they want to. So that's one positive. Yes, corn's under pressure from last week, but we haven't seen a whole lot of new aggressive selling from the managed funds. So if you do the math, 177,000 contracts, that's 885 million bushels. We grow, north of 15 billion bushels. So that's their current bet. They're a bet short. Soybeans, they're only short 11,000. They covered 22,000 contracts last week. So they're short 11,000 contracts. That's basically like having nothing on. If they had a position on, you're going to be closer to, 100, something like that, where it really makes a difference. 10, 11,000 contracts is not substantial in my opinion. If you switch over to what are they long, they're massively long bean oil, on 55,000 contracts there. They had been record long canola. They were long over 100,000. They're still long 87,000. They did sell about 21,000 contracts last week, but they still have a major long bet there. So they're short corn, they're short beans, they are long bean oil and canola oil. Moving over to the wheat, they're short all three of those. In KC, they're short 43,000. They did cover 4,000 last week. They are short 52,000 in Chicago. They covered about 9,000 last week. In Minneapolis, they're short 11,300. That was the big swing. They sold 10,300 contracts. So they basically flipped it, got short. And I think that's one reason, they are selling into new lows there. We'll get to Minneapolis later, but Minneapolis slid to a new contract low on Friday. And moving over to cotton, they're short 40,000 contracts. They added 1,500 new shorts. Again, not a small position, but nothing massive. But they're still, betting on lower prices. There's a couple things I'm going to get to cotton later on too. It's in a very interesting formation on the charts. Lastly, let's go to the protein complex. What are the funds doing there? Live cattle, they're long 132,000 contracts. They sold 1,000 last week. Their previous record long bet was 157,000 contracts. They're long 132, so they're creeping towards that. And based on the commitment to traders data, which we got Friday with the placements, which were a big miss to the bullish side, they're probably going to add to that long. Feeder cattle, they're long 37,806. Why so specific? Well, that is a record long bet for feeder cattle for the managed funds. So they are betting with the rancher. Lean hogs, they're long 110,000 contracts after selling 4,000. Their previous record long bet, 135,000. So they're about, they're closing in on making a run at that as well. And if we get a couple good days of action this coming week, they'll probably add to that as well. Okay, so there's the money flow. That's what these guys are doing. And then as far as, what levels do I want to defend? If I'm working with a new client, I would be very, very clear. I want to defend corn in the bin with September puts. At least defend it past the August 12th USDA report. Absolutely, positively get something on there in case we continue to slip lower. For new crop corn, I want to defend 420, 415, 410, something in there for the next 2 months, depending on your budget. 8 to 13 cents for those. That seems reasonable to protect against something no one wants to see. And that would be corn with a 3 handle in front of it. And make no two ways about it. If these corn takes out 407 for whatever reason, they're going to sell more corn. For soybeans, new crop beans, you want to defend 10.10 or $10 at the very least. Um, Soybeans have had two trips from 960 up to 1075, 1080. We did that twice this year. We were just there in June, and here we are back down to 1020. That did not hold well. So worst case scenario, I want to make sure that everybody's hedged $10. Why would you do that? Well, because if we're finished harvest and we're at 960, 950, you're going to want to have that $10 floor. And you can do that for the next 30 days for roughly around a dime. You call me for specifics, but you don't have to spend a ton to protect a lot of revenue. And then, of course, depending on when you join me, if you've been working with me all year, you know that we got the 20% sold of December new crop corn at 470 earlier, and we got the 30% sold of November 25 beans at an average of 1066. Did I know that we were going to move as far south as we did? Absolutely not. If I had known that, obviously I would have told people to sell more than 20% and 30%. You were able to, on those highs, to protect 460 or 450 corn if you wanted to. And when beans traded, 1075, you were definitely able to protect 1050 if you wanted to. So those opportunities were kind of fleeting. If you missed them, it's like crying over spilt milk. You can't do it, but we may get back there again. There's enough window here in the next 6 weeks to see what happens with the weather. It's possible. Anything is possible. And that's, I guess, brings me to this other point. Now, why would you want to work with a broker? Why would you choose to work with me? It's because during a long marketing year, there's going to be opportunities there. And if you're busy living your life, taking care of your family, running your farm, you can't always be on top of the markets. That's what, that's my job. This is all I do. It's my passion. I love doing it. And so I stay on top of it because I know I'm doing homework that, let's face it, it takes time to do all this. When I do these weekend charts, I spend about 3 or 4 hours of them. When I get up in the morning and I do my numbers, I spend about an hour, hour and a half. That's time that you don't have to waste doing it. Not that it's wasted time, but it's time consuming to go through and really take a look at it and keep yourself abreast of where the support and resistance levels are. And our whole goal here is to try and make better cash sales. If we could just make cash sales and not hedge, like if I was psychic or had that ability just to tell you where the highs and the lows were, of course we wouldn't hedge at all. We hedge when we don't know what is over horizon, and that's something I'll keep coming back to time and time again if you work with me. Okay, so we're going to get into the charts, and I did put a thing in here, a link to a book. People always, if you're new to technical analysis, new to charts, a lot of what I do is based on charts. I read this book in 1989 or 1990, Technical Analysis of the Financial Markets. If you're interested in getting just a rudimentary knowledge, which I think everybody should have, what's a chart look like? What's a high? What's a low? What's a trend line? All that type of stuff. It's a good basis, and you should really be conversant in it. You don't have to be an expert on it, but you want to be able to understand the sort of the basic, the thumbnail sketch of what's going on. So with that being said, let's get into the corn. If you look at spot corn, it's a type of corn. Why do I keep telling people there's 20 to 40 cents of risk there? Well, it's because the old lows on a long-term chart suggest that that's possible. If you go back to the August lows of last year, it is about 39 cents lower than where we are now. Now, me pointing that out it's not me promising you, it's not me being Babe Ruth promising you, oh, we're going down to, we're going to break 30, 40 cents, sell everything. No, I'd say it's a risk. And rather than sell too early, suppose we get a weather issue or something changes with pollination, all of a sudden, like, oh, we thought the crop was going to be bigger than it is, then you have made a bad cash sale here. So I would rather do a substitute sale with a put, spend 8 or 10 cents to defend against that possible 30, 40 cent downside risk. That's how you do it. That's what a hedge is. The hedge is there to basically put a sell stop in there, which you get to elect later on if you want to. There's a cost associated with it, but you don't get any margin calls. So it's basically like a tourniquet. You're playing a tourniquet. Imagine if you're in a war situation and you got shot or got cut. That tourniquet stops the bleeding at that price, and then hopefully we recover and get a chance to sell corn higher. Okay, sort of the highlights from what I saw with September. In that contract on the week, we had an inside week down. That means we didn't take out last week's high, we didn't take out last week's low, but we did settle lower. We had an 11.5% trading range, 11.5 cent, excuse me, trading range. The high was 408 three quarters, and the low was 379 and a quarter. For the week, we finished down 9 cents. And if I'm long corn in the bin, I want to make sure that I've got something under this contract, because what you don't want to do is be sitting there with nothing sold and nothing hedged. And if we take out 391, which is the contract low, 391 and a quarter, there's a danger that we continue to go lower. So how do you defend against that? You got to get yourself a foot. New crop corn, we also had another inside week down on the charts. We had a 12-cent range, and for the week we finished down 8.75 cents. The contract low there is very important, 407 and a half. If that fails, that opens up the door potentially to 384 and then possibly 375. Once again, me saying it's a possible risk is not me promising you that. It's just the natural progression that if we start running lower and funds start selling more, we'll tend to go down to those types of numbers, which historically have been something to watch. So there's risks there. I'm not super bearish, but I want to have a floor, because my job as a risk manager is to make sure that your unpriced grain is protected. What levels would I look at for December corn? Well, are we going to get back to the May high at 456 and a half? I don't know. It's going to take some sort of storyline to change it. Now there are some rumors floating around that there might be some problems with some pollination and some of the seeds. I'm not going to name names, but that did get floated heading into this weekend. There were some issues with obviously with guys talking about temperatures that were too hot at night, or tassel wrap. I mean, at this point, when you're sitting, at the bottom of the trading range, people are looking for sort of any port in a storm. So I'm not going to say it's not possible, but it's going to have to be pretty impressive to turn this boat around. The spring insurance price was 470. I'd love to get back up there to 470. Like I said, I just don't see the kerosene that's going to do it right now. So in the meantime, you want to defend. New crop soybeans. We had a weekly range of 18.75 cents, almost 19 cents. The weekly change, we dropped 14.75 cents for the week. Again, what do I want to do there? I want to make sure I defend $10. And we really can't get anything going bullish until we settle north of 1050, 1075. That would, I think, would get the funds to flip from their small short position to a long position. Now we get into the three classes of wheat. No two ways about it. That they are depressed. They're flirting with contract lows. We'll start with Chicago, September. We had a range of 18.75 cents. Finished down 8 cents on the week. That's after we made a new high. We made a new high for the week, but then settled lower. That was disappointing. That's called a bearish hook reversal. For those of you who are conversant in that type of stuff, all it means is we made a new high and there was no follow through, which is a sign that we may go down and retest that 522 contract level. Kansas City wheat, we had a weekly range of 16.75 cents, but for the week we finished down just 2.5 cents. That's almost a victory. And the only number that really matters for KC September is 515. That has to hold for the bulls. If we take out 515, you're going to see funds do what they do, which is they add to winners, and right now they're short. So if we take out 515, you can probably see some more downside risk. If you are long wheat without a hedge, get yourself a hedge. Can't say that enough. You don't have to spend a fortune, but I would get something. Spring wheat, that was probably the most disappointing. It took out its contract low from 586 and a half, made a new low. In the last 5 weeks, this contract gave back 81 cents. We had what we thought was the start of something there back in June, and it just completely fizzled. Wheat, corn and beans have all been a 3-year downward trend. A lot of people were hoping that we get some issue that would catch us up, but no two ways about it. If you're long spring wheat, if you've got puts, we're going to be rolling them down. If you don't have puts, I would say get something on the book. I did tell you I wanted to talk about cotton. You're at a very, very, very important level here in cotton. Cotton's in this big wedge for the past 3 months. Resistance, if we can get above 68.90, this is basically 69 cents, that'll be really positive. We'll be breaking out of this wedge. All that means in the wedge is you've got two trend lines there. If you take a look at the letter, you'll see. But it's very, very important. It's kind of a turning point. Now, on the flip side, if we go lower, if we take out support below, down around 67.5, that could be negative for cotton producers. So, we already went down to close to 64 cents earlier in the year. We don't want to get back down there again. Um, if you can protect, 67, it's better than 64. Again, how do you protect it? You've got to get yourself some sort of a put, in my opinion. We got a foot, so we're sort of end on a positive though. Bean oil and canola oil both been on really big rallies as of late. We came off 3-year lows, and that's people say can corn, wheat, and beans turn? Well, absolutely. Look at bean oil. Bean oil was in a 3-year downtrend as well. It's carved out a bottom and turned higher. Again, we just need either more demand or a weather issue to sort of catch all the shorts there. And but fundamentally, there's not a whole lot out there to write home about. That's why we've been trending lower. But both canola and bean oil have given producers, if you're long canola and bean oil, we've had a good rally. You'll protect it. If you look at crude oil, boy, what an interesting, few months that's been. Back in the middle of June, when it all went down with Iran, we were closing in on 80 bucks. You had people on TV talking about $150 oil again, and that all completely fizzled out. Thank goodness. Are we going to go back down and test the 3-year lows at 55 bucks, which we were there in April and May? It's possible. I think as long as we stay under 70, you may get a little bit more drift lower, but that's a two-sided thing as well. I mean, if you're long corn, you actually want to see crude oil higher. You want to see crude oil above 70. That helps the ethanol build. That helps the whole ethanol equation. So yeah, well, it's nice to see gas lower. If you're long corn, you actually have to see prices a little bit higher. Diesel fuel. Keep an eye on diesel fuel. Back in May, we were actually sub $2 on the futures 2 or 3 times for about a month. And then, of course, we had the spike up in June with the Iran issue. We had traded up towards 260, 270. We've been trending lower since then. If we get a dip back down to 210 or $2, that may be a good buying opportunity for anybody out there if you're looking to replenish your diesel, heading into the fall. Now there's still a big window out there, and if that happens, you'll be getting an email from me saying, hey, crude oil is, diesel has dipped low here. Let's try and take advantage of it. Okay, and then let's gotta finish with the bull market, right? Go through all this bear stuff. Let's get into the bull market. It's got to be the cattle market. Feeder cattle, fat cattle, all look like they're going to be higher on Monday. The cattle on feed numbers came in friendly on the placements. It was a pretty big miss for the placements, and we'll see if that continues. This market has been completely almost bulletproof, right? And the levels I'll be looking at for fat cattle. Okay, let's start with August fat cattle. Well, are we going to take out the all-time high at 229.125? It sure looks like it. I think if that takes out, if 230 falls by the wayside, it definitely opens up the door to 234, possibly even 240. For the high this week, we saw a high of 227.40, and we finished the week in live cattle up nearly 3 cents a hundredweight. So we were bid into this cattle on feed. My guess is on Monday we'll probably open up with a bid as well. Something to continue to watch in the live cattle. Well, there's another thing or two. Now we're going to move over to the feeders. Feeders have just been on a crazy rally for the last 10 months. On Friday, it finished on its highs, new contract highs. It didn't care about whatever risk they thought was coming out from them to trade the cattle on feed report. If we take out 332 in August feeders, 332 opens the door to 340. I hate to say it, but if we take out 340, then you're going to be talking about 350. I know just It just seems like yesterday we were all talking about $3 cattle. So it just keeps going on. I wanted to mention one thing, talk about, well, how would you protect this rally? Not calling a top, but if you wanted to protect some revenue. I was just spitballing some stuff today, and I looked out. You could go with for 186 days. Go out there. You could reach out. You could defend 310 feeders. You could do a 310, 290 put spread for 5 cents a hundredweight. That's a 4-to-1 risk reward. It covers you for 186 days. That's the type of stuff that I would look at if I'm long cattle and I want to make sure that if you go to bed one night and something changes in the headlights, in the headlines, and in the headlights or the headlines, if something changes and we're under pressure, it'd be nice to have that floor in there. And if you can go out and spend $5 a hundredweight and collect and protect 20, that's a good 4-to-1 payoff. And if you're paying 5 cents a hundredweight, you're paying $2,500. That's a reasonable amount of money to spend to defend 10 grand worth of risk in a feeder cow put, in my opinion. If you look at the lean hogs have had a very volatile year. Back in April, when the stock market corrected, we dipped all the way down to 72.40. It was a contract low. People were very concerned, and then 8 weeks later, 9 weeks later, we were $25 cents a hundredweight higher. We went from 72 to 97, right? And then just when people were starting to get really friendly and really bullish, here we go. We're going to be just like cattle. We did have that 38% correction, almost corrected half of it back. But since then, we again shrugged it off. Cattle trade differently than lean hogs. Lean hogs are generally more volatile. It can be much, much more difficult. That's why I'm a big believer that if I'm a hog producer, I want to be using options as opposed to futures. Futures, it's very easy to get stopped out of your position just when you need it. With the lean hogs, when we get these rallies, there have been some really good opportunities to defend revenue. So that's a general overall look. Again, the overall concern that moving forward will be what is going to turn the corner, what is going to get us bullish for corn. It's going to have to be a pollination issue. It's going to have to be something that's not in the headlines right now. Now tonight we did get the news that we signed a trade agreement with the EU. That's great. What we really need, though, from a commodity trading perspective, is we need to have the deal with China. Everything else has been cleared up now. Now with the EU, it's nice that the EU is going to be straightened out here with the US. It's nice that it's going to help our oil producers, but the EU, when it really comes down to it, they don't buy enough corn and beans to really move the needle, and that's what you and I, who are listening to this podcast, and we're involved in the ags and the row crops. That's really what we need. We need that deal with China. We need some solid news, which will really help us figure out, how are they really going to come get more of our beans? For the past decades, they bought generally 25% of our bean production. We need that to maintain, and we also would be nice to see them add to it. Historically, they really haven't taken a lot of corn from us. It would be nice if they took more. I think if you listen too much to the general media, they forget about that. Mexico takes more corn from us than China does, but that falls by the wayside. But if we could ever get a solid deal now with China, that would really, really help. So that's about it. I just kind of went through everything: corn, wheat, beans, all the different risks. If you're looking for help with your risk management, right? If you're worried about sub $10 beans, if you're worried about sub $4 corn, and if you don't know what to do, reach out and give me a call, send me a text message. I can help you defend the revenue. You don't have to commit to spending a tremendous amount of money to defending this revenue. There are a lot of different strategies we could use. And it's something that I'd love to talk to you about. If you're looking for help, give me a call, 312-638-8868. This is Chris Robinson with my Sunday night podcast. I hope you found it valuable. I hope it helps you. Again, and if there's something you don't understand, if there's something you want to ask me, call me directly. We'll cover it on the phone. Look forward to talking to you. Have a good night. Take care.